I'll start with a little bit of chit chat up here on the stage, just to get things going, and we'll be sure to leave plenty of time for your questions. So you may want to think ahead to that. You've seen the bios of the panelists in your book, so we don't need to belabor the point, but I would like them each to just say a few words by way of introduction, a little bit about your background and how you got to this point. We'll start at this end, Shonda, and move down.
So I came out of Stanford GSB directly into venture capital about 20 years ago, and Eldorado Ventures is an early stage fund, and we focus on information technology, and 80% of what we do is first round investments, and then we follow them through. So everything from components up through services, consumer as well as enterprise sorts of opportunities. My background originally was in engineering, so I moved from engineering into marketing and then to graduate school.
Shonda, it must have been pretty unusual to go straight out of business school into venture.
Somewhat, but I had sort of 6 or 7 years before undergraduate and graduate school, so I'd had enough work experience. And some of you will remember the bubble in the late 90s. There was also a bubble in the early 80s, which wasn't quite as big, but had the same sort of cyclicality to it. So having been through that, I had a better shot getting into venture at that point.
Great. Mike?
Yeah, I actually graduated from Stanford as well, ancient history class of 90, and then went to business school on the East Coast. Spent about 10 years in Austin getting involved with 2 startup IPOs, Tivoli Systems, and then a company I helped start called Motive. Moved back to Silicon Valley and decided that there was an unserved market in the VC business between angels and traditional funds. And so my basic investment thesis is that 500K is the new 5 million, and that there's a wave of capital efficient opportunities enabled by low burn experimentation and abundance in technology. And I've had a pretty good run of beginner's luck so far, but no exit.
And Mike, do you have LPs or this is?
I do, yes.
Okay. John?
John Gendrella. I was rejected from Stanford Business School several years ago. Went on the East Coast.
We'd like to reconsider.
I was actually going to bring my rejection letter. Entrepreneur by nature, started a collection of companies pre-business school, took time off, went back, came back to California, originally an engineer building satellites for Lockheed Missiles in Space. Actually spent some period of time doing, as Mike did, angel investing in a collection of startups, some technology, some non-technology. Built a couple of software companies, and recently, a year ago, joined a company called Voxify, delivering speech applications, and currently the CEO of that venture.
Great.
Chuck Siegel, and I'm also kind of a career entrepreneur, but in the food business, specifically chocolate. I started my first chocolate company when I was in business school in Rochester, New York. Moved out here for a real job, and within a year had quit that to start my first legitimate chocolate company, which I had for 7 years before selling it when my first daughter was born. Charles Chocolates is my newest company. It's a chocolate company, and by the way, there's a lot of chocolate down here. Far more than we need for a group this size, so by all means help yourselves. And started that company just over 3 years ago here in the Bay Area, but did not study food. I'm completely self-taught. It's a business I found myself enjoying and loving, and like I said, with a break to do a few .coms between my 2 chocolate companies, it's what I've been doing for over 21 years.
So serial entrepreneurs are rare. Serial chocolate entrepreneurs. Are you the only one you know of?
No, I know of one other. But he's a crazy Frenchman who's had about 4 chocolate companies over 50 years.
All right. Okay, so you can see the setup. We have in that corner a couple of folks on the entrepreneurial side, and in this corner a couple of folks on the financing side. And so, hopefully through those different lenses, we'll be able to get a couple of perspectives on the funding puzzle. So I wanted to start down on the entrepreneurial side. of the table. And John, maybe you could start, and then Chuck, if you'd chime in. And the question is, how you think about, given the business you have in front of you or that you're envisioning, how do you think about a funding strategy and who it is that is your ideal kind of financial investor?
Sure. I think, and I'll speak from a broader sense, not just my current company, because I think I've been rejected by a collection of different funding sources. I think there's a couple things you keep in mind. Number one, you sort of stick with the basics. Funding is staying alive. If it's your first round of funding, it's your ticket to the dance. You get to play. If it's a subsequent round of funding, it is staying alive another day, because every entrepreneur believes that another day I can make something happen. So I think there's 2 points that I'd make. Number one, investors fund milestones. So I think the game to me is, I look at what tomorrow is supposed to look like. I have a vision of what tomorrow may be, and then the investor looks at that and says, that spot there, is it a good spot? Can you get to that spot? If you get to that spot, does it validate something in your company that allows you to be fundable for the next phase of your plan? So one is this real idea that investors fund milestones. Every time that I was doing something, I was trying to identify. I sort of started with the red dot on the mall map. You are here. Drew a picture of where I wanted to be, and then said, I need to tell a story about going from here to there. And if somebody believes it, it's a good spot, and I can get there, then I get a chance. The second point that I would make is that I think you have to match investors to investment type. So let me explain what I mean by that. I've done a variety of things, actually sitting somewhat in Mike's chair in the angel investing, so I think like an investor. But you have to look at what the company is doing at that point in time. Is it, for example, are you in development phase? So you're trying to determine, can I build this thing? Is it a pilot? Are you going to build out your first pilot? Is it early market acceptance? Can somebody other than a relative, actually, buy this thing and pay me cash for it? Am I determining if the business model works? So is it my scale test? If I grow this thing, how will the economics of this company work? I look at the economic model over time. So there's a variety of different tests I think that you take all the way up to expansion stage. The model already works, got a product working, things are happening, and I'll just add a little rocket fuel to it. So I think you look at, what's that company trying to do, and then B, what's the hold your questions till later. B, who's the most appropriate investor for that? So, and it's important. Take an example. I think there are folks that are built to be early stage investors. They understand the dynamics of that first 5 guys in the garage, the trials and tribulations you have in that, how difficult it is to do that first 180 days. So if you're a startup with 5 guys in the garage, you don't go to a late stage investor. If you are in a particular category, for example, some of the groups today look at different, have different focuses. You're a SaaS company, that's kind of sexy today. If you're a SaaS company, you might look at a VC firm that has, a very good experience, in that industry, so you don't have to educate your investors on the type of business model that you want to, pursue. So I really do think that you look at the type of company that you have, the stage that you're in, ask these appropriate questions, and then really match that to the type of investor that is most appropriate for that, because you really don't want to spend a lot of time educating your investors. You're trying to essentially get in there with someone who gets it fast.
Thank you. Chuck?
I agree with what John's saying. I'm going to actually take his 2 points, which I think are probably the most appropriate, and do them backwards. We're a consumer goods company, and we're basically making chocolates. So we, right out of the gate, we're dealing with a much smaller pool of potential investors, at least here in the Bay Area, than another style or type of company might be looking at. So for us, it was an issue of, okay, we're making a food product. There are only so many early-stage investors that have experience enough to properly evaluate what we're doing beyond, wow, this chocolate tastes great. So for us, it was really a strategy of identifying those investors, figuring out the the clearest path to them, and then getting in front of them. The ideal investors for our first round were basically angels. And our first round was, with the exception of 2 angel groups, formal kind of angel groups like the Angels Forum, for example, they were all individuals, but all individuals who were either successful entrepreneurs in consumer goods or successful entrepreneurs who understood manufacturing specifically. So we really went at it because, quite frankly, I didn't have a lot of time to waste raising money, trying to be as efficient as possible in identifying those people. In terms of funding strategy, again, to John's early point, it was really about figuring out how we got basically from this little 500 square foot kitchen that we were renting to where we are today in a 12,000 foot kitchen efficiently and with a trajectory that an investor could look at and say, this is a path that I can invest in. And again, if it's achievable, it gives us either enough scale to be a successful company, or it gives us the scale necessary to attract larger investors for a B round. So we structured the investment basically against specific milestones, again, because we knew that we had to achieve something in the marketplace before, if you will, larger investment firms would look at us seriously. In the consumer goods space, it's a little bit more difficult. First, not necessarily because there's a greater attrition rate, but because as a rule, the exit strategies first tend to be a little bit different, and they tend to have a lower value than a lot of technology exit strategies. So investors are, I don't want to say wary necessarily, but they evaluate manufacturing and consumer goods companies a little bit differently than, say, technology companies.
Yeah, thank you. So, Mike and Sean, I want to ask you the same question from the flip side. I mean, there's a ton of filters you apply when somebody walks through the door, but what are the filters in terms of type? This is type. This just isn't my kind of business. What's in the sweet spot for each of you? And I imagine it's a little different given you're in slightly different approaches here. Shauna, do you want to?
Yeah, I mean, I will do that. Before I do that, can I comment on what they said? Because I think the guys have hit on something really important. This investor type question, because one thing I think entrepreneurs often don't consider is that if you're raising money, it's a sales process. You're selling your company, right? You're selling shares in your company. And all sales processes are emotional. All the data, and this is especially true in early stage. Later stage, you got to have more data, but no one's going to look at the data to do the due diligence and the analysis unless they fundamentally get hooked. So your job as an entrepreneur is to find, first of all, to be efficient. Find people that are likely to be hooked by your story. Hook them emotionally so they actually want to do the deal, and then provide them with the data that they need to justify it to themselves and their partners. So I think a lot of entrepreneurs don't really look at it that way. They think, well, this is a funding thing. It's different from selling. But if you're successful in selling a product or service, take those lessons that you've learned and use that to sell something that's much more interesting, more intangible, more eminently malleable, which is the story, the vision of your company. So I'll say that. So I think that's, and you can save a lot of time if you do as much homework on your investors and target your investor group in the same way that you target your prospects. When you go to sell a product, you want to make sure you got the buyer who has a budget, who has a need. Do the same thing with the investors. So in terms of Eldorado, I can't tell you how quickly I hit the delete button when I get an email that says, first of all, dear Mr. Ballas, I looked on your, okay, sorry, as a gender comment, but same thing, misspell the guy's name, right? Mr. Marple, looked on your website. I think you are the perfect fit for us. We do, I'll use retail because we don't do, we do retail goods in South Florida. Now, our website clearly states that, we're early stage investors. We like to be close to our entrepreneurs. We're active in essentially California, Texas, and Minneapolis, because that's where we have some partners from originally. But really, it's West Coast venture capital. That's what we position. We do have portfolio companies in other places, so if people find us there, that's fine. But what our message is to the entrepreneur community, if you're West Coast, information technology, services are fine, but some kind of technology-enabled play, and you're early stage, so your first or second round, then you should be coming to talk to us. And if I get an entrepreneur or a group that comes in and says, so, I know you're on the board of, or you or one of your partners is on the board of these 3 companies that we think are incredibly synergistic. There's a little tick in. Okay, this guy or gal did their homework. They know what I like, and they're gonna present this in a way that is much more likely to appeal to me and my partners. So,
good, thank you.
Just one general observation, just from being a former entrepreneur, I found that fundraising is either ridiculously easy or ridiculously hard. It's binary.
Yeah.
And so, and paradoxically, on the side of investor now, I want somebody to walk in the door and be in a total position of strength. So my advice is that you should be so ridiculously easy to fund that you look at it like you're hiring your investors. And the problem is that most people aren't ridiculously easy to fund, which means that it's ridiculously hard to fund, and they haven't done enough work and preparation and proven the business enough to be able to hire the best people. And so then they get married with bozo investors, and then now all of a sudden that hurts the business. And so my advice is do what it takes to make it easy, or do more homework. But I find that there's no in between. I've never found it moderately easy to raise money.
What does it take to make it easy?
Well, I think that a few things, world-class expertise in an area, and that world-class expertise translates into a fundamental insight that's different from the conventional wisdom, but that's provable based on that expertise. Another thing that I see that distinguishes people is having accomplished customer development milestones in addition to product development milestones. Too many companies present an engineering project as their company plan rather than how am I going to get customers and how am I going to use money to drive the business and build it forward. And so, those types of factors, everybody has their own capricious criteria when they invest. But those types of things, visionary entrepreneur with unconventional wisdom, customer development, fundamental advantage, modest capital requirements are the things where, if proven, they get my attention right away, and very quickly I get into a mode of saying, well, let's talk about why you should hire me rather than other investors, because we're not going to spend a lot of time me doing 10 times more due diligence than I should, which is just an excuse for not doing the deal.
Okay. So I'd like to move on to the matching question, and how do you find one another, right? And so from both perspectives, from your side, and maybe we should start with the entrepreneurs. What are the effective ways of finding sources of funding? And here we're talking about individual firms, individual angels. It's a very daunting prospect to people who've never done this. I mean, you think you have a great idea, but who's going to write you what seems like a large check for your harebrained idea, right? And so where do you find these people? How do you start the conversation? How do you go about it? And from your perspective on this side, how if you think back, of the last 10 companies you funded, where did they come from? Were they so easily fundable that everybody knew about them and there was no search, or is there some process that you go through to kind of find the diamonds in the rough? Chuck, why don't we start with you?
Sure. Well, I think one of the easiest ways is to look at what your early assets are in terms of the people involved in the business. One of the things that you hear all the time, and it's true and it's appropriately true, is investors invest in good people and good teams. Early on, oftentimes you don't have a team developed yet. You can't afford to hire the best people. So what most companies, again, do, which is very important, is they put together not necessarily an early board of directors, but board of advisors. People who are helping them, who have industry expertise, so that not only do they help the company get off the ground, and they lend some credibility on the side of that, of kind of the business side, but by and large, there are also going to be some people who have connections in the investor community that might have interest in your type of business. For me, that was the first path. I had an incredible board of advisors made up of people not necessarily from the food world, but from consumer goods and from manufacturing. And several of our early investors, not including people I came to the game knowing. I mean, I'm 45 now, but I was 41 when I started the company. I already had a good community of people that I could call my friends who were investors. But the people outside of that personal circle, they came from my board of advisors and connections that they had to angels who had experience investing and interest in investing in companies like mine. The other thing I did is I took a look at who was out there as established angel groups that had consumer goods experience and had interest in investing in consumer goods companies. Because again, it's a much smaller community than kind of like the general technology investing group that's here in the Bay Area. So it was a very quick afternoon at the business school library. It took about an hour and a half to find all of them.
How many were there?
Pardon?
How many were there?
Four.
I was going to say less than 10.
Right. It took the rest of the afternoon to contact them all. So again, obviously doing your research, whatever industry you're building a product in, there are going to be people who are out there who want people to know about them. So they'll find ways through the industries and through the investment community to make themselves known. You just have to find them. But the easier path, and again, using efficiency, the more efficient path is to use the people who are already helping you or involved in your business at other levels to identify early stage investors.
Right. John, anything to add on?
Yeah, I think, Shonda hit on a point earlier. I think when you're raising money, you are selling. And I think that selling is buyers look for low risk and high upside. So you're really creating a story that demonstrates low risk and high upside. And then you ask, how do you do that? I don't think you should ever go cold to an investor. I think one of the points that Chuck made was you're always leveraging your network. I think one of our first things, we probably created something that was the precursor of LinkedIn a lot of years ago, really trying to figure out who each person knew. When you go out and start talking to these people, there's a piece of that you shouldn't lose. It's not just calling up your buddies and who knows whom and what have you. Every discussion is an education. Somebody's banging a rough corner off of your idea. So when you're having a discussion with a guy about, I'm thinking about doing this, or it looks this way, or I'm thinking about going right or left, they're telling you where you're an idiot. Take that advice. You're going to talk to 50 people before you actually make an investor presentation. And if you have your ears open, you actually learn something through every one of those conversations. The second piece that comes from that is you find an evangelist. You find somebody, and I'll speak from my investor perspective for a moment, but you find somebody that gets the story and then actually wants to help you. And you'd be amazed at how many people want to help you. You tell them the story. They tell you at first how much of an idiot you are. You reshape it. You think about things more, appropriately. And then that person or those collection of people actually say, I know who might like this story. I got a couple of friends who I think this is right up their alley. So I never, and I tell you, I raised money for everything from, athletic clubs and did credit card financing and all the way to like owner take back, carrying notes on real estate, to angel money, to institutional money, to debt. I mean, I think I've covered the whole spectrum in terms of fundraising. And in any one of those scenarios, I never went cold into any conversation with somebody that had money. Somebody was taking me into that meeting.
So can I add one quick thing?
Yeah, sure.
Actually, John hit on a great point, and this is actually it's like a part of doing the pre-work, if you will, to an investor presentation. You actually never want to go into one of those legitimate investor presentations in a position where they're going to be pointing out what an idiot you are. They will anyways, but
yeah, they do that. Anyway.
They'll do it anyway, but
you've heard it before.
Exactly.
Yeah.
Ideally, you'll find someone to work with to make the presentation to several times before you actually go out and make it for real, because there is no such thing as a perfect business plan first time out or second or 10th. So you really do want to, prior to talking to someone who could actually legitimately invest in your business, have it nailed. And the best way to do that is to have some very, very critical people work through the presentation with you. And there's nothing better than kind of no holds barred, kind of tearing the plan to shreds process, because it really helps.
Yeah. Mike, is this what it sounds like on your end of the table? I mean, how do you look for people to invest in?
Well, it's interesting. One of the things I learned is just get lucky in the first 5 years. And so the venture business is an increasing return business. And I moved up here from Austin, Texas, and just first investment I made was Twitter. The second investment I made was Dig. The third investment I made was Yumi Networks. The fourth investment I made was Aggregate Knowledge. And my deal flow just exploded. And so getting lucky actually turns out to be important. But I think that the more durable, premeditated strategy is to be known for something. And so I think there's too much money in the venture business, too many people investing, too few will make money. And so entrepreneurs, not just you, but entrepreneurs need to be able to articulate on the tip of their tongue why you're different. And so my goal was to be the first person you call if you want to raise between $250,000 and $2 million. And if entrepreneurs play that message back to me, I'm successful. If they don't, then I won't get any deals. Certainly not any good ones. Yeah, certainly not any good ones.
Yeah. So if we just run the tape back and we go to before it became easy. Now, let's think about those first four investments when you came in. You were not well plugged in. You said before you got lucky. I don't think a run like that is necessarily luck, but we'll take the modesty. But I mean, at that point, how are you finding these investments?
This is going to be embarrassing too, but my son likes Star Wars, so he wanted me to film him in the backyard with a lightsaber. So I was rotoscoping blades in Adobe Photoshop, and I saw a tutorial on Dig. So I called up Kevin Rose and said, I'm interested in your company, and he liked that reason.
All right.
So that works.
Like
I said, it's pretty random lucky. It's not modest.
Have the right son.
Yeah, that's right. Have a son who likes Star Wars. Yeah, so but the other thing is a little bit less facetious. Some investors, I think, develop a point of view about what's interesting. And so I think one thing that was an advantage for me was that I was looking for a citizens media type of Web 2.0 company. And I'd seen a lot that I wasn't excited about. And so when I saw this tutorial on Dig, I was prepared to receive the insight that it was interesting. Right? I could have seen it like 1,000 other websites, but instantly I knew, oh my gosh, I'm interested in citizens media and the architecture of participation. And fortunately, when I called Kevin, he thought, oh gosh, this guy gets it, and he really likes what I'm up to, and he cares about what I care about. And so I think that having an a priori perspective on what you care about does help.
And Shonda, what fraction of deals that you end up doing came over the Transom, which were introduced to you?
Right. Yeah.
I mean, how does that break down?
Really easy, zero over the Transom.
Zero over the Transom.
Never, we occasionally get one that's interesting enough that we start looking at it, and for whatever reason, it's never happened. It's a very small percentage that kind of actually get attention anyway,
right.
Even the ones that haven't been. So it is all through a network. And so one of the taglines that we've used over the years is we want to be the point of first referral for the highest quality entrepreneurs. And the way we do that is we want to make our reputation in the entrepreneurial community. Not that we don't like working with the rest of the venture community and our brethren, as it were. But again, syndication, which is the process of putting more than one venture group together in a given round, comes in and out of favor as the cycles go in and out, as capital requirements come up and down. It's dropping out of favor again because there's relatively little money required in these early stages. So we do get deals from other early stage venture groups that are looking for somebody that I think John mentioned that there's a certain style to being an early stage investor. You're looking at different things. You do need to have a point of view on an industry or a set of dynamics that you believe are going to, in the long run, help a company get from A to B. So we work hard on our entrepreneurial network, and roughly, I'd say 2/3 of the deals we do come through another entrepreneur who refers the team to us. We have we consider a captive group, which is a side fund of successful entrepreneurs that are actually active. They may be active angel investors, maybe not. They may have gotten to a stage in their career where they've decided they don't want to put out $100,000 to everybody who asks them. I mean, in the bubble, that's kind of if you got If you had gotten wealthy, all of your friends in the business would say, hey, invest in my company. It gets increasingly hard to say no if you become known as a person who can do that. So some of the guys just channel their activities through us. And then we also, repeat entrepreneurs is a really interesting question because, serial entrepreneurs, serially successful entrepreneurs, there's this question of, well, if you hit it big once, are you really motivated to do it again? Not that you're not capable, but are you really willing to do what it takes to get something from zero to several $1 million? Because that is really, really hard. It's sort of like I built a deck once, actually sawed, I jackhammered the concrete, we sawed the laws, and that was it. I just never felt the need to do it again.
To check that off.
Yeah, I checked that box. So a lot of times, and you'll see this a lot of guys who start companies successfully, if it's not a big enough hit or if they're too young to retire, they'll say, I want to do that again, but I want to start a little later in the process. I'd like to have some customers and some revenue. So, but there are those people who are just dyed-in-the-wool serial entrepreneurs. They can't get out of their system, and they're just been hit over the head once too many times. They love that startup, that blank page where you say, okay, that one's blank. I can create something from scratch. Those guys are awesome. There's not a lot of them on the planet. When you find them, you try and get them to hire you to take your money. So there's that. I think that's, but that's how we find. So the entrepreneur community, in a couple words, is how we do it.
And if I might just add one other thing, the good VCs, deal flow is actually their enemy. They see too many deals, and so they're not necessarily looking for more. They're only looking for the best ones. And so I think that the other key to recognize that when you get introduced to a VC, when you bring your plan to a VC, they're grading you on a curve. There's only so many meetings they can take in a week, and you either make that cutoff or you don't. And so I'd always be asking myself, what do I have to do to make the 5 to 10 cutoff list of the deals that they're going to pay attention to that week and say, you know what, I want to reach out to them and see what they're up to. Because if you miss the top 10 list, they're not going to pay attention to you for at least 90 to 180 days.
Now that is really true. It's someone whose name I can't remember said, if you want me to write a novel, I can get it to you at the end of the week. If you want me to write a short story, it'll take a couple months. It's that pitch, that elevator pitch, which people, you say, well, it's just I can't possibly tell my story in 2 minutes. Well, if you can't tell your story in 2 minutes, it's going to be really hard. So that I would really second that.
So I'm going to ask just one more question, and then we'll open it up. And I think it's the obvious last question, which is about, how do you make yourself attractive, and what do you find attractive? And Chuck, I'm going to start with you. I mean, and I want let's talk specifically about the most recent chocolate business. How do you sell a chocolate business?
Well, it's actually embarrassingly easy.
Samples.
Exactly. It's kind of like the concept, and we'll go back to the idea that, in fact, I was selling my company. And using the analogy of selling my product to a Whole Foods, Andronicos, whomever it is that we're selling our product to, this is the easiest product on the planet to sell if you make a really superior product. I joke that I don't sell, I feed. So the process of selling investors on our product, or rather on our company, was ridiculously easy. I would introduce them to the product first, and by the time they had 5 or 6 pieces of chocolate,
they were comatose.
Exactly. the sugar high didn't hurt.
Yeah.
But half of the job had been done for me, because in every process that you go through where you're trying to find investors, you are trying to convince someone that you actually have what it takes in terms of product or service to build a market, to create something special that will basically return their investment. In my business, it was very easy because there aren't that many. There's probably no more than 10 or 15 of us in the entire country making chocolates at this level. And the people who understand consumer goods, and so many more people now understand premium chocolate, understood that immediately. Combine that with the fact that very few of them are business people. I had the advantage of not only running my own business, but running several other businesses subsequent to the first, that people also recognize that not only did I have the ability to create product, but I probably somewhere had learned something about business and could take that and build a business out of it. It's a really interesting industry in that most people who get into it are retired pastry chefs or not retired pastry chefs, and not all of them have the ability or the wherewithal to actually build a business around a product idea. So yeah, kind of going back to the first statement, it was probably the easiest part of the entire process was getting the investors interested in investing in my company.
So chocolate wrapped in a term sheet. That's,
Basically,
that's
well,
right.
no, it was actually chocolate preceding anything. So our term sheet was actually written very early in the process. So one of the things that and actually this is another thing, one of the things I didn't want to do is have a whole lot of different people trying to negotiate terms. So I identified one of our key investors in our Series A very, very early and offered them the opportunity to work with me, with my board of advisors, two of whom became directors, and our lawyer to craft the term sheet very, very early in the process. So we were actually presenting a term sheet to the lion's share of the investors rather than having them come in and feeling like they had the right to do that for $50,000.
Yeah, that's a good point.
John, you've raised a lot of money. Think about a specific successful instance, and what is it about that?
Sure. Well, we fortunately just closed a $15 million round a couple of Fridays ago, so it's actually quite current. But I'd say something before, talking about this specific deal. I think, there's a couple things to remember. One is, you go back to telling that story. You're telling a very attractive story to somebody to get them excited about your venture. But you have to remember, it's a financial game. At the end of all the buzz and the hype and the happiness, whatever, somebody actually has to take their checkbook out and write you a check for millions of dollars. And so you think about that process, in some scenarios, like one of the recent ones, I had a champion at the VC firm that I wanted. I had to not only win him over and his partner, they were sort of, tag team there, but I knew at the end of this multi-week process, I had to win over the entire investment committee. So there's a lot of folks in this process that you have to get energized about getting your company funded. And you've got to picture this. And I'll tell you, anybody who's been to the VC offices, whether you're a young entrepreneur or even later stage, they're an intimidating place. I actually believe they're an intimidating place because like they said, there's 50 deals that went through there that week. They know they're only going to get the attention of a couple of folks. Even if you have one champion that really abdicated your story the entire time, you're going to walk into a board meeting and then 6 other people that probably don't genuinely care about you. 2 may be having a bad day. 1's not even in your space. But you got 6 or 7 people around the board, and they're going to go, you want me to write you a check for how many millions of dollars? So I think you got to really understand that you're asking somebody for a lot of money, and to do that, they expect to get a return from that. So you never lose sight of the ROI calculation in this whole game. As emotional as it is, as buzz-friendly as it is, it's an ROI calculation that all 7 of those folks around that boardroom are gonna do before they write you a check. And I think I'd go back to some of the basics. The company that we just funded, I think it's an interesting scenario in that I actually thought it was relatively tough. And you think about, why that was. It was a later stage company, so it had already been around for, 5+ years. I was the new guy that got parachuted into it. Already a couple of rounds of funding had gone into it, so there's already a couple of big bets have been placed. There's millions of dollars into this thing already. I'm going to go back out to the market and tell a collection of later stage investors that understand this domain that I have a plan to go from where we are today, and there's actually, it's one of the challenges about a later stage company, there's too much data. They actually know where you are today, the good, bad, and ugly of where you are. They have a couple years of history of that. They can go talk to your customers, they can talk to your partners, they can talk to your ex-employees, they can talk to your board, they can do more homework on you than you want them to possibly do. But I go back to sort of the original story. I knew when I came into the company that I always rely on my red dot at the mall, you are here thing. I knew where we were, I had to come up with a picture of where we needed to go. And I think on the first day of entering the company, I told the team exactly what milestones we would have to achieve just to get a chance to be fundable. Right? I knew exactly what and I don't mean this like I was smart, but I knew what we needed to do to be attractive to folks like this. And it took us a year to sort of reposition the company and do the things that would make us fundable to the outside investor community. We had to demonstrate that the technology worked. We had to demonstrate the scalability of the SaaS model. We had to demonstrate that a growth potential would come through this partner distribution channel. So we went from this direct company. I won't go into the details of the company, but I'll just highlight the fact that it was a transitioning period that we had to get through in order to reach a milestone that said, I'll write you a check. So this whole growth strategy was via new partners that weren't proven. So you walk into the VC office and they say, that's a good strategy, that's a great way to grow the company. Come back a couple quarters from now when you show me that that stuff's working. So you had this sort of history that you were trying to get over and a future that looked cool, but sort of a show me after after it starts to work a little bit. And then you're stuck in the middle sort of needing cash today to make payroll. So I think we did a fairly decent job of focusing the entire company on the things that demonstrated the us being fundable. We demonstrated the scale of the company. We demonstrated the traction in the partner channels. And the folks that we presented it to got that story, championed us, took us through the process, and then ultimately wrote us a check for $15 million. So it worked, but there was, and I'd say this, it was some guys get lucky. I have not. They go in there and somebody's offering them a term sheet on day one. We worked for a year to get the company to a fundable state, and then we got the funding, and that was even that was a multi-month process. So,
thank you. So, Mike and Shana, from your perspective, if someone's lucky enough to make it into the firm and they get to pitch, what is it you're looking for? Top 2 or 3 things.
I'll say, okay, so first of all, I think I'll go back to I think the first order is a big problem. So really the first thing it's going to, you can call it the marketplace. I like to think of it in terms of the problem space. There's got to be a big pain point that you're trying to solve that for one reason or another people are willing to spend money on. It could be a proxy, it could be indirect, but it's a big problem that you're going to solve. Secondly, people that are, if not uniquely, at least in short supply, qualified to solve that problem. So that's the domain expertise. That's finding people that know something about the space, actually know quite a lot about the space. I really don't like investing in teams that come from another marketplace and say, yeah, I'm not from this marketplace, but I've looked at it, I've studied it for the last couple months, and boom, I got it. Chances are it looks good because you don't know enough about it. It's the guys that really know a space well and are still willing to start a company in it. Those are the ones you want. And then the third thing, really, and it is in this order, which is tough for particularly engineering or product-oriented people to hear, and the third thing in order is the solution that's being proposed. And what we look for is something that is protectable in some way. It doesn't have to be patents. It can be trade secrets or know-how or just something elegant, unique that hasn't been thought of before. It typically is timing dependent. That interaction between, particularly in technology, sometimes a solution that you just couldn't build 5 years ago. Either the components weren't there, or the building blocks from a software standpoint weren't there. The Web 2.0 stuff, you couldn't do that 5 years ago. You didn't have the LAMP stack that you could build an app on top of for less than $500,000. So I think those 3 things are what we look for. And another way, again, I like to put this in analogies to sales cycle. And one of the many sales processes that are out there is you have to convince a customer why they need to buy anything. That's that the market's big enough or the pain point's big enough to matter. Why do they want to buy you, your solution? So again, that's the people. And why do they want to buy now? And if you get those 3 things done in a sales situation, then you get somebody to write you a check. Same thing if you're selling a company. You got a big enough pain point with people that know how to solve it, and a product that is timely for some reason. There's a reason why it hasn't come to market before. There's a reason why you can build it now.
Great.
Those are the 3 things.
Mike, anything to add?
Yeah, I largely follow some of the same criteria, but the only thing I might add is that I think the way you make money as an investor is to be non-consensus and right. And so because there's too much money, being consensus and right, you can make so-so returns. If you're wrong, you lose money regardless. And so being non-consensus and right is what you look for. And so whenever I make an investment, I hope that I can articulate on the tip of my tongue what is it that we know as a team that the world doesn't understand yet. And if I can't articulate that with confidence and precision, I usually can't invest.
That's a great point.
What are the options available to non-tech entrepreneurs, and how you evaluate them?
Specifically early stage?
Yes.
Okay, because later stage they become much more conventional. But early stage, again, it's not that the funding options are different, whether it's angels, angel groups, or other traditional investors. It's that for consumer products or non-tech products, it's just a smaller community. So for us and for most of my peer group that I know of has kind of raised money recently, there are angel groups that have an expertise in consumer products or have partners with expertise in consumer products. So that was the first place we went, because we knew if we could get a hearing with them and if we could get one of those groups to take an interest in the company, it would be that much easier to attract individual investors. A lot of early stage investment is individuals, especially when you're looking at $500,000 to $2 million. You're not really at a stage, regardless, where a VC firm is going to really take much interest in what you're doing. So you're looking at smaller individual investors and angels. So again, they're out there. It's just a very, very small percentage of the overall investment community. In terms of identifying them, again, it's all about building a network that has access to those people. Again, it's a small enough subset of the investment community that pretty much everyone knows them also. A lot of people that I know who invest in technology businesses exclusively were the ones who referred me to some of our early stage investors, because they all knew it's like, oh yeah, but here's this guy over here. He doesn't really do many of our tech deals, but he loves toy companies, packaged good companies, whatever it is. And that's really how you find them. It's really just building a network.
What do you do when you have an opportunity to present to a broad group of investors, in this case?
And there'll be 40 companies presenting over
2 days.
So you're in a bake-off with a bunch of other companies. How do you stand out? What do you think? Anybody who would like to take that?
It's really easy. If you can tell your story succinctly in 5 minutes, you will distinguish yourself from 80 to 90% of the other companies that are there.
Bring chocolate.
Yeah. That's why Charles is so easy. You just hear it. That's what I do. If it's a technology company, you just have to be able to describe what it does very clearly and why it's, why it's better, different, unique. So the 3 things I said: what the pain is, why you've solved it. Now, in that format, you don't really have to create your bona fides. You don't have to introduce your team. You just have to speak knowledgeably enough that people. This is just a ticket, right? You just want the investors in the room to come up to you afterwards and say, "I'd really like to hear more about your business." That's your goal, right? You're not trying to walk out of there with a check. You want the right to go in and spend an hour with X number of these people.
Good. Yeah.
Question. Why would someone want to go to a VC as opposed to a conventional bank for finance?
Sean, what is it you bring to the table? So the question is why VCs as opposed to banks?
Well, okay. So 2 things. One, banks are very unlikely to give money to a startup that has no revenue. Kind of stuck.
What fraction of the companies you fund do you get zero bet on? Or
zero bet. So roughly a third.
A third.
Over a long period of time, an early stage fund, it's going to be roughly a third, no return, a third pay for everybody else, and the third in the middle are tweeners, 2, 3 X's.
yeah. Banks don't like that.
Banks don't like that. Banks are all about assets and cash flow.
Not theory.
If you don't have cash flow, vision, not so much.
Except for this very odd period we've just been through where they lost sight of all of that.
Well, the debt markets are cyclical too. They
Yeah.
get a little crazy, but not typical.
But they're back to their senses. Yeah.
So in the life cycle of a startup, there are multiple stages and there are different opportunities to get funding. What is a good stage to go to a VC, and what kind of milestones do you tend to look at?
The way I like to look at it is there's a stage in a company where you're doing customer discovery before you're doing customer validation. This goes back to customer development thinking. And these days it costs very little to figure out if you solve a problem that somebody will pay for. And if you actually solve a big enough problem, people should be willing to pay for a half-done product. I mean, I remember when I was at Motive, we charged people $50,000 for the right to receive alpha software someday. And the reason that we did that was we wanted to understand whether we really solved a big problem or not. Because I was about to spend 5 years of my life in the foxhole bleeding with bullets flying around some idea. And so my belief is that not enough entrepreneurs go to VCs with a validated proposition that customers will care about. They go to VCs and just want to shoot the bull and say, hey, do you think this is a good idea or not? And heck if I know if it's a good idea, right? I'm not a customer. And so the answer to whether it's a good idea or not is always outside the building. And so the degree to which you can come with facts and rather than opinions about whether customers will pay and how much they'll pay and how valuable it is, I think is a big thing. The other general rule of thumb I have when I make an early stage investment is we should raise enough money so that we have 6 months of cash after we've proven something big. Because I want us to be able to approach the venture people from a position of strength. And I want them to know that if they slow roll us, we'll just move on. And that we'll easily get funded. And it turns out that's actually good for the VCs as well. The VCs want to fall in love with a company and get straight to due diligence and get on with life. They don't want to come up with 10 reasons to give the slow no. And so those are the two things I really look for.
Shona, where do you like to come in the food chain?
Well, you know, we're a little bit earlier stage than some. I mean, early stage got to mean almost anything except the mezzanine round. But we will do anywhere from a couple $100,000 to $1 million in a seed investment. Each partner can only do one of those a year, so it's not all of what we do. But we'll go from very much a seed thing. Our first round is going to be typically, let's say, $3 to $5 million for a company that has a product and has some customer validation. Right?
When evaluating technology companies, do you have a preference for product versus platforms? In other words, a product, something that has a defendable market, customer base, and problem that it solves, or the platform, which can be applied to a number of different product areas, potentially in different industries. Do you have any preference on which one you'd like to see?
So the question for the investors is how do you feel about platform plays versus specific problem plays?
Yeah. For us, it's really, it's sort of the vision thing versus the go-to-market strategy. Platforms are great in theory, but they're also that thing that most people, thank you, can't explain inside of sort of 2-minute horizon. So the ideal thing for me really is something that has the potential to be a platform, but has a very specific go-to-market application product that people want to buy today.
I couldn't agree more. There's two conversations that bug me that happen a lot that I just think are false. The first is we're platform.
Yeah.
And I think every great platform I've ever seen, successful features and products begat having a platform.
It evolves.
Nobody started with a premeditated goal to be a platform. The second thing that bugs me is when people talk about their brand too early. And so I don't think that Larry and Sergey were saying, oh, gee, what's the Google brand going to be? I think that success begets a brand rather than the other way around in Silicon Valley, and that these meetings that go on in boardrooms where they say we need to be some brand early stage is just a waste of time.
Yeah.
So when it comes to looking at partners, you have a small startup company, you're talking to various different partners. Do you have to have an actual contract in play, or do you have a letter of intent when looking for VC funding?
I just want to talk to the person and see if they're super excited or if they're just being the puppet of the entrepreneur to say good things to get me to invest. But usually you can detect how passionate the partner or customer really is. And that's what drives me is this idea that somebody's invented something that customers are so passionate about they just can't quit talking about it, that they just feel like we have to be doing business with this person. Yeah,
contracts can be overrated. It's the people behind them. You can get a contract in place. A lot of startup companies will get into trouble where they'll land a big fish, right? They'll get a deal with a large company, and then they realize that that company is actually much worse than they are at actually performing on the contract.
I have a huge example of that, by the way. When I was at Motive, we had a $15 million deal with one of the big PC OEMs. We had a rock-solid contract, no contingencies. And so then the meltdown happens in 2001, and I go have a meeting with them, and they say, we're not going to pay you. And I said, well, what are you talking about? We've done everything in the contract. You're not saying you're unhappy. We're just not going to pay you. We've changed our minds. We don't want to deploy your product anymore. And I said, well, you owe us the money. It's against the law for you not to pay me. And they said, well, do you see? And this guy was from Houston. And so the guy goes, well, Mike, you see that building next door? And I said, yeah. He goes, it's full of lawyers. How many lawyers you got? And I realized, right, I didn't have a lot of money to spend on lawyers suing a huge multi-billion-dollar conglomerate PC OEM. And so, contracts with hard contingencies aren't so contractual in a downturn. So that was tough. $15 million, tough to have go away.
How do you see a early stage startup pursuing M&A strategy, excuse me, versus organic growth? So, do you think is good, or do you have concern when you see that kind of company, high-tech company pursuing M&A deals versus organic growth?
It's a very unusual situation to have a strategy to grow by acquisition. You need a currency. If you're not funded, so we're both early stage people. So if you're not funded, then you're going to be acquiring with stock, and if you haven't been funded, then it's hard to set a value on that stock. So roll-ups without, prior to funding are pretty unusual. Yeah. Also, the other thing is private-to-private mergers are really difficult. Easier if there's no venture money involved, frankly. But doing private mergers is really just fraught with a lot of problems.
Do you mean because? Are you talking about post-merger integration, or what's so difficult private-private merger?
The investors on either side both think their company is worth more than the other one. It's really just getting the investors to agree at a price to merge the organizations. And then, of course, the CEOs or the teams on each side each think that they should be running the final thing. So you've got to merge people and you've got to merge valuations. Again, without venture investment, when it's angels, it's actually a little easier. They tend to come together more easily. But John was talking about having 7 people in a room. One of the things about venture, which is absolutely true, is that there's a lot of really smart people with even bigger egos. And so if you got 2 syndicates in 2 different companies that have not quite made it on their own, so they're looking, let's get bigger. And this was very true in the last 3-4 years. Size really has mattered more because the IPO level, the IPO window is really, you want bigger companies. So a lot of VCs looked around, like I said, we're smart people, so we go, okay, we need bigger companies. How do you get big? You get the number 1 and number 2 in a space, you merge them together, and now you have the clear leader, or you get the number 2 and the number 3, you're now the leader, you can go public. Problem is, you get 2 capitalizations, 2 sets, a lot of these companies were funded at the bubble, they've got 30, 40, 50 million in capital in them, and everybody's trying to figure out how that money is going to get merged together and what the outcome's going to be. It's really hard to get people to agree.
Yeah, in my experience, there are no mergers. There are only acquisitions.
Yeah.
And
somebody has to win.
If it's not clear who's acquiring and who's getting swallowed, it doesn't work. And given those scenarios, Facebook goes buys a little bitty apps developer. I think that can work. But if it's company A,
yeah, exactly. Right? I mean, they may be private, but they have
exactly.
currency.
But if company A and company B think that they're about to get into a merger of equals, look out.
Question at the back.
I have a question. When a proposal is on your table, do you look at it versus we're going to sell this company in 5 years down the road, or we're going to go IPO with it? And if the answer is yes, how do you treat them differently?
This is something I feel pretty strongly about. I don't believe I have the ability to predict how a company's going to do. If it's sufficiently disruptive and innovative, there aren't a lot of comparables. You have a sense that there's a huge potential market, but it's more like potential energy, right? If it's an obvious big market, then that's not a good deal either. And so the way I look at exit is not as a number, but as a probability distribution curve. And whenever a company is raising money, I go to the entrepreneur and I ask, okay, well, what exits do you want to eliminate with this financing round? Because because the fact of the matter is, upstream investors are going to expect a certain return, and if you go raise money at a $50 million valuation, you're not going to have a $25 million exit where you make money, or even a $50 million exit, or probably not even a $100 million exit. So I try to help the entrepreneur have very good facts about what the probability distribution curve of exits has been from 01 to 08, and then based on that, take your strategic choice about how much money you want to raise and at what prices, and let's make the probabilities in the curve play to our advantages rather than be something that we have to be captive to.
Really good point. You know, when you take additional financing, you are opening doors and closing doors at the same time. You know, if you have an opportunity that can be accelerated or leveraged by additional capital, that's opening up new doors. But you are closing off other options, other opportunities. The other thing I would say is, this is an old maxim, which I think is very true, is successful companies are bought, not sold. So if you go into a company saying, okay, I'm going to put this together to flip it, you're not going to get as good an outcome as you just say, look, we're going to build a great company here, and chances are, if you look over the history of tech investing, chances are somebody will come along and offer you a great price for it. That's a viable alternative to going public, and then you have a great decision to make.
At this point, I think we're standing between you and chocolate, which is never a good place to be. And so please join me in thanking our panelists.